What up, people? Happy Wednesday, right? It's Wealthy Wednesday. Kind of lost my day there real quick. But today we're going to talk about Kellogg's and the new spinoff strategy that the company just announced yesterday. We're going to talk about the what, the why, the when, and the how. Actually, we won't get into the how so much today, but we'll talk about all that and what it means for investors and what it could potentially mean for the next generation or so. All right. So again, I'm Kamari Ellis. Welcome to the Finance Rebel Show. Finance Rebel Show is a show dedicated all about money, right? The whole show, the whole channel is all about money, stocks, business, taxes, economics. If it's about money, we talk about it, especially as it relates to how the little guy or little gal can take their funds and then become financially independent. Because actually, everybody can become financially independent no matter where you start. It just takes a bit of a mindset shift and some hard work and some smart work on top of that. So again, we're going to talk about Kellogg's. Let's jump into it. Let's jump into it real quick. I know everybody wanted to talk about Kellogg's last night, and I just didn't have it in me. So I said we'll talk about it today. And I actually have some other shows planned because I've actually been getting a lot of questions lately. Been getting a lot of questions about Kellogg's lately. But as you all know, Kellogg's is planning to spin off its business units. Three of its business units. Kellogg's is planning to split up into three different businesses. Not three different divisions, but three totally separate businesses. So that should be pretty interesting, right? There's a lot of jewels there. There's a lot of things that you can take from corporate moves and you can look at them and say, how can I apply this to my personal life, to my personal finance? So we'll definitely get down with that tonight. All right. So let's jump into it. The real quick and dirty, right? What's going on? Again, Kellogg's is going to intentionally split itself up into three different units. And I wrote some notes down, right? They're going to be splitting themselves up to their North American cereal unit, their plant-based unit, and then they have a snack unit. All right. So that's kind of the guts of it all. Now, when you look at Kellogg's, they are not small potatoes. When I was looking at it, I forgot Kellogg's has some of the biggest brands that I grew up on, right? Like Tony the Tiger. It's great. I wasn't allowed to eat Frosted Flakes. My cousin was allowed to eat Frosted Flakes. My mother would always say, you can't eat Frosted Flakes because it's got too much sugar in it. So I could only eat things like Corn Flakes, which is a Kellogg's product. I could eat Rice Krispies, which is a Kellogg's product. I could eat Raisin Bran, which is a Kellogg's product, but I couldn't get none of the fun stuff. What is it? The Smacks, again, Frosted Flakes. I couldn't get any of those things, but those are all Kellogg's brands. Kellogg's is approximately a $23 billion company. So they're no small fry. They have plenty of money. They make plenty of money. They do, I wrote down some notes, they do about $14 billion a year in revenue, and they do roughly about $2.7 billion in net income. So after they get their revenue, after everything's said and done, everything's paid for, they have about $2.7 billion left over, and that's what they're able to put in their pocket, right? So again, not a small company, definitely major brands. Been in business since 1906, so it's roughly like 105, 106 years they've been in business. So they're doing a thing. They're doing a thing. Now, I want to pull up an article that I read. Actually read a couple articles, but I want to pull up an article that I read on Wall Street Journal, and just share with you some of my thoughts on that as well. So give me 1 second as I pull that up. Give me 1 second. My internet's moving a little slow. Not sure why. Let's see there. See if I can find it. Let's see there. Here we go. Here we go. Now, I was supposed to have this all done by the time the show got started, but I got delayed a little bit today. Because I got a call from one of my mentees who's actually doing really, really well and actually made my day. And he asked me, is it a good idea to buy annuities? But we'll come back to that. I'm going to do a whole show on that as well, probably the next day or so. But give me 1 second as I pull up this article on the Wall Street Journals. So this is what happens when we are live. Sometimes you get to see when I get some glitches, I don't have everything queued up as I'm supposed to. And let's see here. There we go. And everything's moving super slow today. All right, give me 1 second, y'all. Un momento. Now, are any of you thinking about buying Kellogg's? Because I've been getting questions about it like it was a part of your investment strategy. So I thought it was interesting. Now, one of the calls I did get from someone, they actually own Kellogg. So I thought that was interesting. So here we go. Kellogg's is split in 3. And I'm going to share the screen with everyone so you can see it. But again, this is a really interesting move, right? And for a lot of, in my opinion, obvious reasons when I look at these things, right? But when you're thinking about any kind of business move or anything, right? Just think about it: the what, when, why, where, and how. And if you can answer those questions, the W's. If you can answer those questions, you can apply that to investments overall as well. All right, so Kellogg splitting into 3 companies as it shifts focus to global snacks. Keep that in mind. It's shifting to global snacks, right? So food company plans to create separate cereal, snack, and plant-based business. So that's actually the what. That's what they're doing. That's right there. The lead is not buried. It is what it is. Now, why are they doing that? That's part of it. And I didn't get to say this, right? For everybody that's chiming in, please make sure you chime in. Let me know your name, let me know where you're hailing from, and let me know if you have any questions. I won't be on long tonight. This will be more of a shorter broadcast, but I do like to say my hellos, right? My mama raised me with some home manners, or with some home training rather. All right, so Kellogg's said it plans to break up its business into 3 companies, seeking to jumpstart its larger, faster growing snacks business. All right, boom, right there. While helping its namesake cereal brands regain their footing on supermarket shelves. The move, which Kellogg said would separate snacks such as Pringles, big brand, Cheez-Its, Pop-Tarts, all major brands, from cereal aisle staples, including Frosted Flakes and Fruity Loops. That's another cereal I wasn't allowed to eat when I was a child. Aims to create more agile, focused companies and marks a shift from the foods industry's decade-long strategy of pursuing acquisitions and building scale. All right, now, this was a quote I think that was really good. Bigness for big sake doesn't make a lot of strategic sense, said Kellogg's Chief Executive Steve Callahan, who will add the $11.4 billion snacking business, which accounted for 80% of Kellogg's net sales last year. Now, I think that's interesting. I think that's very telling that the chief executive is already eyeing which business he's going to run. He already knows where he's going to run. Now, there's a reason for that, and I'll talk a little bit about that in a minute, but he's He's kind of showing his hand. It's kind of showing his hand a little bit. But let's get back into this. All right. Now, there was a couple other pieces. All right, so here we go. Kellogg said it expects to complete the split by the end of 2023. So that's the when, right? What, when, why, how, and where. Kellogg said it expects to complete the split by the end of 2023, with the North American cereal business potentially separating first, followed by its plant-based food business as the third company. Kellogg said it also is considering selling the plant-based business, which is predominantly composed of Morningstar Farms brand. It has yet to name the individual companies. So they're splitting up. They're thinking about doing a sale. Now, they also did a sale about 2 years ago of a major brand. And that's a major clue. So we'll definitely get to that in a minute. All right, so Kellogg stock rose. We don't really care about that after this. Now, this was released yesterday. Kellogg's breakup plan follows split announced last year by General Electric. So General Electric already split, and Johnson & Johnson in the food sector. Kraft Foods orchestrated a similar split about 10 years ago, spinning off its North American grocery business to focus on its faster growing snack brands, including Oreos, Triscuits, a business it's named Mondelez. Mondelez is buying stuff. Mondelez just bought some things today, or this week rather. Now, Mondelez is Kellogg's competitor, major competitor. So that's their competition. So Sara Lee Corp in 2012 split its business into two companies, one meat-focused operation renamed Hillshire Brands, and an international coffee and tea business called DE Master Blends, NV. So that's normally companies, but the NV is for Netherlands. All right, Hillshire, DE Master Blends, and Kraft all later merged with other big food companies. The largest of Kellogg's three playing companies would be the global snack business, which would include brands such as, pay attention, y'all, such as Pringles, Cheez-Its, and breakfast items, including Eggos and Pop-Tarts. So I can't help but think about Lego My Eggo. So that is some good branding. That is definitely some good advertisement, because they probably been saying Lego My Eggo since the 80s. I'm showing my age. All right. It also would include Kellogg's international operations, fastest growing noodle business in Africa, and cereal sales overseas. So these big conglomerates have various operations, various ways of making money, various ways to market themselves. But they're so big, and he kind of talked about it in the beginning, that it's really hard to focus because they have so many different ways, so many different options to kind of take from and pull from. And so they're saying, hey, let's just focus on the hottest thing right now, which is snacks. Figure out how to grow that business, which they've been growing. It's pretty substantial already, and how to make it bigger, faster, and stronger. So this is going to be interesting. This is going to be interesting. Now, saying further, the snacking business will have all household names with just the right level of scale, Mr. Collin said. And when you don't have the conglomerate effect, you can get a lot more done. So basically, they don't want to be bogged down with the conglomerate effect, right? Because when you're bigger, right, you move slower. Think of David and Goliath. David was smaller. He was a little bit more timid, masterful with his tool. Goliath was big, definitely imposing, carried a lot of heft. But anytime that it wanted to make a move, it has to move slowly. It can't move on a dime. It can't move fast. If you ever think about, like, when you see motorcycles in traffic, how agile and how flexible they are to kind of move in, weave in and out of traffic and get to where the cars can go. Same kind of principle, right? Smaller, nimbler, faster business, shed off these other older units, and let's get busy growing this business to be a big powerhouse again. So that's the mindset, that's the thought. Now, I don't believe this was just done today, yesterday, week before, month before. I believe they've been laying the seeds to do this for a while. And there was a sale of a major, give me one second, of a major brand that they owned. And so to me, that was kind of telling. And that sale happened in 2019. Let me look at my notes. That sale happened in 2019, selling it for 1.3 billion in cash. How many of y'all would love to have a sale of 1.3 billion in cash of an asset that you own? I mean, that's phenomenal. That's absolutely phenomenal. Let's see here. So I'm going to pull this up. Seems like everything's slow today. Here we go. Here we go. I don't know why everything's slow today, and I have absolutely no control over it, which I don't like, but it is what it is. I am pulling up this other piece I wanted to show you all. Just let me hop into the comments and say what's up, everybody. Saturn Crushes in the building. How are you? How are you? Said, Jose's here. What's up, Jose? How you doing? Let me go back. Saturn, why'd you say, Curious to know. Jose here. Peace to you as well. Northern Bell, you know what? I appreciate you comment on every video I put out. I gotta give you the horns for that. I very, very much appreciate you. Because, sometimes I'll be wondering, is anybody watching? Is anybody looking? What are they looking? YouTube and the algorithms over there kind of favor videos that do well like the first 24 hours. So if you can watch a video in the first 42, or if you're getting a lot of views in the first 24 hours, algorithms tend to up it and show it to more people. So again, it's kind of the get along gang here. If you can get along with the algorithm, you will be okay. You will be okay. But if you buck the algorithm, it's not so easy. It's not so special. So I wanted to show you this chart of many of the sales that Kellogg's have done, sales they've done, sales they have, or purchases they brought as well. So I should really call them acquisitions. So, all right, so Ladina says she already owns sales. All right, and so Northern Bell, she says she appreciates my content. By the way, my glasses on. I hate wearing my glasses when I'm on camera. All right. Well, I appreciate the fact that you appreciate me. So thank you. But as I was saying, these corporations move very, very strategically. And again, as I said at the top of the show, you can actually implement some of these things in your own personal life. Now, you might not have billions of dollars of doing things, but you can start moving strategically and buying assets all along the way to make things happen. Now, I want to show you this, right? This is going to show you just how methodical and strategic Kellogg's is, right? So here, this is a timeline of their quote unquote recent acquisitions. Recent going back to 2020. Excuse me, 2020. Why am I messing this up? To 2000, dang it. Going back to 2000. All right, so they acquired Pringles in 2013. Wilmar is an international joint venture that they acquired. And actually, let me do this. Give me 1 second. Well, you know what? I'm going to keep going. Now, if we go back to 2000, Kashi. Now, if anybody knows what Kashi is, but Kashi's another cereal brand. I don't see Kashi in all the supermarkets, but I know I see them in Whole Foods, right? Morningstar Farms. Some of my vegans, some of my vegetarians that eat Morningstar actually really rave by it. We know that plant-based is starting to grow. Plant-based foods are starting to grow and create a bigger revenue generating opportunity. So they brought this back in 2000. So they were definitely ahead of the trend, right? So again, they've been working to build up these assets because each one of these businesses, each one of these brands is indeed an asset. All right, so you got Pringles, Wilmer, Toleran, African joint venture. That's where they're selling stuff to people in Africa. Then they acquired Food Mass, again in Egypt. So they were coming to Egypt, somewhere between 2015 and 2016. Bisco, again, was an Egyptian biscuit company. Snacks, right? 2016. Parati, Brazilian biscuits and pasta maker. Again, Brazil is one of the biggest economies around the globe. And they also acquired RX Bar. It says the fastest growing U.S. Nutritional bar provider in 2017. And in 2018, they expanded more into West Africa. Now, got all those, and I already told you that they sold Keebler as well. Maybe I didn't. I told you $1.3 billion sale, but it was a $1.3 billion sale where they sold Keebler, right? Keebler cookies, things like that. So that shows you that they've been very intentional laying a lot of this groundwork because they were trying to get assets, right? Sell assets and get ready for this. So I'm not sure when this CEO took place or took office, but let me find out. But you can tell this is a well-laid plan. Now, there's a lot of things that go on when you see companies start to either merge with other companies or split up. It's not easy. And so I know everybody's question is going to be, well, how are they going to do it? And how is that going to impact my ownership? Like Ladina said, Ladina owns shares of Kellogg's. I don't know all the particulars. They haven't quite announced it. What normally happens in these situations is that the people who own shares in the original company will tend to get shares in the companies that split off and go into a different direction. So when GE split off, they had Win Healthcare and another, I want to say Energy Healthcare and another company. Everyone who owned shares of GE subsequently got shares in each one of the companies that were spun off. And they figure out some kind of ratio. You know, if you got 100 shares, maybe they give you 5 shares for each share you have in each one of the companies. But those details have not been released yet. I don't think all the plans have been released, but they're coming. They are coming. They are coming. They are coming. And then the other thing is when you do these transactions, you have to ask yourself, well, how are they going to unwind all this? So there's another article that I didn't get a chance to get into, but it's talking about how are they going to break down these companies? Because there's going to be 3 different balance sheets, right? So how do you break up the balance sheet? Now, if you know what the balance sheet is, it's one of those really, really important accounting statements, financial statements that all business people should be familiar with, right? Because that is the statement that tracks all the assets you have, all the liabilities you have, and then that will tell you the net worth of a company. So that they're trying to figure all that out. It's still being worked through, but I think it's going to work out just fine. And I think everybody, especially some of the older investors, will be very, very happy. They'll be very, very happy. Now I'm going to pull up some more key data on Kellogg's, surely. But right now they're paying a dividend that's like 3.4%. Not bad. Not bad. Not bad at all. And let's see. I want to see stock price. Let me share this. Stock price year to date. They started at 65 bucks. So they've kind of been flat because right now they're at $67. So again, it's been up, but it has been great. Now, when you look over the last 3 years, they're up about 20%. So it's not bad, not super spectacular, but just okay. But again, they're still a powerhouse. They're still making plenty of money. It's definitely a major company in the American business landscape. So, it's going to be a thing. But as I get more information on this, I will definitely come back and talk to y'all about this. Now, I didn't think anybody's going to be interested in this until I started getting some calls and some inboxes about this. I've been talking more about taxes, and I've been talking more about some of these social media gurus that love to give out terrible information, but they think they know what they're talking about. One of the ones I will tell you all that I saw today that had me thoroughly appalled was someone said Bitcoin is up 80% year to date. People are still investing in cash. Cash is trash. Just invest your money in Bitcoin. Then what happens? Bitcoin crashes. Now, I know some of y'all think I'm a Bitcoin hater. I am not. I just realized that all these different asset classes have different cycles. They go through different things. They all have characteristics of their own. And when you are starting to build your portfolio, you have to understand them and how they work. And I will always tell y'all cash is greater than credit. Cash is king, always and forever, not to be misspoken or mistaken for religious commentary. This is all financial. This is all financial gospel right here, right? But why cash will always be king. And I was talking to my young mentee just before I got on the call with y'all that cash gives you speed. Cash gives you flexibility. Not to say that you're not supposed to invest your money, but when you have cash, you can make some things happen. That's why when people have cash and they want to go buy a car or buy a house, they typically get the better deals and they typically get to close faster. And it's more convenient. It's more convenient. All right. So here's the question. I knew somebody's going to ask this. Right. So I'm wondering if this is the time to buy. That's the $1 million question. Right now, I am. But in all seriousness, that question you have to answer for yourself. I can say, it's a good company. Is it right for your portfolio? I don't know. Right? What's your time horizon? Time horizon, in my opinion, is probably the biggest factor in investing, long-term investing. That's what we talk about here on the Finance Rebel Show. Long-term investing. So when are you thinking about needing these funds? What will you need these funds for? Right? The what, the why, the when, the how, the where are all important questions you need to ask yourself anytime you're thinking about any decision, right? Financial, romantic, stock, bonds, any of that. And ask yourself, is it really that important? Because again, we all could just buy ETFs, exchange traded funds, and be okay, right? Stock market tends to go up anywhere between 7, 8, 9, 10% every year. If you get an ETF that kind of matches that, tracks that, make anywhere between 7, 8, 9, 10% every year, and you'll be fine. And you don't have to worry about trying to pick individual stocks. Now, if you are like me, who actually gets joy from it, and I'm always looking to get above average, then yeah, you might want to try to pick out high flyers and companies that do well. But there's more to this story. There's more to the story. Again, they're already a winner. The question is going to be, will they be able to continue to win? Who will run these companies? We know the one company is going to be run by the current CEO right now. So you could probably say that company will probably do okay. Now, the question is, again, what's okay for you? And that's the million, billion, $1 trillion question. Let me get an arrow. Right. What's right for you? All personal finance is personal. I keep telling everybody that. I want to keep telling y'all that because I don't think people get it. It's all personal. And I don't want to sit here and lie to you and sell you some snake oil and just say, hey, buy it and then buy into my program and then make me rich without telling you you're making me rich and we'll all be just fine. No, you got to do your own work. You got to have some discipline. You got to do your research. That's just the simple truth of it. And if anybody tells you any different, they're lying. Now, Jose says, depending on your investment strategy and risk tolerance, it's always a good time to buy for long-term investing, my opinion, not advice. Now, here's the thing, right? In my experience, he threw out that R word, risk tolerance. What I have learned is that for most people, not all people, most people, risk tolerance floats. Most people's emotional state, right? Well, let me back up. What is risk tolerance? Risk tolerance is how well you can deal with the movements up or down, good or bad, of an investment. Are you okay with an investment falling 20%? Would you continue to invest in it? Would you continue to hold it? Versus, how do you feel about the investment if it's up 20% overnight? All of those things factor. The risk tolerance kind of comes in. It's a financial planning / financial services tool that they use to try to gauge what's good suitability. Now that might sound like a funny word, suitability, right? But suitability is this investment suitable for you and your situation, right? Is it good for you and your situation? Does it match up with what your needs and overall expectations are? That's what suitability is. And that's what risk tolerance tries to gauge. Again, in my experiences, people get more aggressive as the market does well. We've had 12 years, 14, actually more than 12 years. Yeah, about 12 years of a bull market. People think the stock market never goes down. And then now everybody is kind of lost right now, kind of befuddled right now because they're like, oh no, what happened to the stock market? What happened to crypto? It's not running high up anymore. It's going down. That's one of the characteristics of stock. Hey, that's one of the characteristics of crypto as well. But nobody wants to talk about that. People only want to invest when the markets are going up. That ain't how it works. That ain't how it works. Just like every day isn't a great day. You got good days, you got bad days. Stock market is the same thing. The question is, how do you stay even keeled to continue to do what you need to do? And that's definitely what you want to look for when you are investing. So again, if it's good for you, bad for you, it really depends when you need the money, right? The company will probably, especially the company, the global snack foods company, will probably do well over the next 20 years. Not an investment recommendation, but just based on what they have, how they're doing right now, the management team that they have, they probably will do good over the next 20 years. But that's not necessarily guaranteed. Now, their plant-based business, I feel, will definitely do good over the next 20 years. But as you see, they're thinking about selling it. I see a demographic shift, but they may not want to invest or make the investment into that sector, into that business to really make it pop. So again, it really depends. It really depends, right? So, all right, y'all. So I'm going to do a part 2 of this. Probably won't be this week. It'll probably be either over the weekend or next week. But I'm going to do a part 2 of this as I get to dive deep into some of their financials, and then I can give you what I feel about that, right? But let me know. Do you think this is a good idea for Kellogg to split into 3? Are you interested in buying it? right? Do you think it will be a good investment for the long term? But until next time, I will see y'all later. Everybody have a great night. And don't forget to like, share, and subscribe if you got any value out of this content tonight. All right, y'all. So long.